The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. Well, we are in the third day of our rally, coming off of what we think was the bottom at the full moon, coming in on 23rd. And if this market is really powerful enough, it could rally another several hundred points in the Dow Jones Industrial Average. But I started the show with the chart of the Dow Jones Utilities to show you, how negative that chart really looks on a longer-term basis, because we not only took out the May lows, but we took out the April lows as well. We're having a little bit of a bounce back, of course, along with the other two indices. We also posted the chart for the Dow Jones Transportations. That showed that we hit a 786 retracement with a Gartley pattern on Monday. And we are in the third day of the rally into the Dow Jones Transportations also. The final chart that I'm going to put in as far as index is concerned is the Dow Jones Industrial Average chart, which basically shows the Dow also had made a 786 retracement, an extension of the AB leg, which we thought was going to happen because of the strength down. And we could get a rally all the way back to 15,000 and change, around 15,040. That would be a 61% retracement off the high of June 17th. Anything more than that would really question whether this was the last great buying opportunity of the 21st century, or we really are going down like we think we're going down. So we'll have to see how the market reacts over these next few days. If we don't get any higher than just a little 3-day bounce like we've had so far, you're looking at something, very, very sinister. The charts look very bearish to me, and they still do worldwide. The other markets across the world have not rallied very much either, and it just doesn't appear that we're in a bull market here. Just looking at this longer-term chart that we're watching in the Dow Jones and the S&P and the NASDAQ and things like that. Basil mentioned the price of Apple and how badly it is performing. That's one of the stocks that we've been following for a long time here on TFNN. Because it had such a beautiful pattern that it formed, in that area. And now we have we have shattered, the 786 retracement that Apple had been holding for quite some time. And that's telling us that Apple certainly wants to go a great deal lower. Basil mentioned the price of $353, and I think that is certainly in the ballpark, because that would be nothing more than a large extension of the price from $480 down to $380 and then up to $460, and you just subtract your ABCD from that, and that will take you down into the $350 level in the price of Apple. If we looked at it on the weekly basis, you can see the price level would easily go there. In fact, I should do that just to make it a little clear that you would be able to see that we would make another move down in Apple, and it could go a lot lower. Let's just draw this little butterfly pattern in that we see happening, and we will check and see if it has that ability. Yes, it looks like that's the price that we're looking at, is around the 350 level in Apple, is the price that we'd be looking at on the weekly basis. This stock is, when it was at 700, everybody wants it, and now it's the wicked stepsister. Nobody wants to have the stock. So my assumption is that this is where we're going, is down into the 350 area is the most logical place, for Apple to find some support. Now remember, it's totally different than the rest of the stock market. It runs all on its own engine, because as stocks were making new highs, the price of Apple had been making new lows all along, and that's why you've got to follow the price of the stock and not the stock indices, because they run, totally different. Nothing has really changed as far as we're concerned. What's happened with the market. We've had a nice little bounce coming off of that, the big lunar eclipse, not lunar eclipse, but the lunar cycle, which was the full moon cycle on Sunday. There was the ABCD patterns right at the objectives that we were looking for in all of the indices. And now we're having this little 3-day bounce. This 3-day bounce is the one that I think is the most important that we're looking at over the period of the next several weeks and months, because if we don't get much of a bounce from here, then we're looking at something that is really, really sinister, more so than things that we could happen in the past. Now, one of the things that we've been watching very, very closely, and Basil does this also, I keep mentioning Basil's name because he's really easy to follow. All I do is keep notes, and I try to repeat what he says because it's so good that it's really hard to bring anything, better than what he actually gives you. And that's what I'm trying to do, is to, give you my idea of what's happened. I hardly ever, or I'm on the wrong side of what he's looking at. There are times, and he's usually the right one and not me, but he's an excellent technician, as is Steve Rhodes. And but these are just chart patterns. That's all they are. There's nothing more than that. I'm just looking at price on one axis and time on the other to give me an idea of where I think prices will go, because I follow what happened in the past, and that usually tells us what's going to happen in the future. Now, I posted the VIX index because that's been the one that's probably been as good as timing for the market as any that we've seen. We had the big ABCD move into last Thursday. That was the the extension that happened up around that 2050 area, and now we're making a pullback that should stop somewhere around 16. We're trading around 1779 right now, and if we get a little bit lower here in the next day or two, down around 16, then we would think this would be the place where the market return. Now, I'm not sure if we're going to do that, but right now the indicators say that we've got at least one more day and possibly two. We've got this day, and then we've got Thursday and Friday, so we could have a whole week rally after the big down move that we had since that started way back on May the 28th, and that would be a normal type recovery. But the stocks still look incredibly bearish, and I really think we're looking at something, very sinister down the road quite a ways. So the VIX index is telling us that we are in the midst of a, stock market rally. It should continue for another day or two, and then we will see what the next thing will be, on the downside as far as what it's going to look like. I want to talk about. We're going to switch over here to let's do corn first, because let's not. We'll do corn tomorrow because we got the commodity show tomorrow. But what I wanted to do now was to put up the chart of silver on a weekly basis and just show you how negative the price of silver is. Once we broke that 26 level, which was equivalent to 1565 in the gold, that told us that we were heading lower. And as we reported, last week, when John from the Tiger Trading Room reported to me about the open interest from the Chicago Mercantile Exchange on what had happened to gold. The open interest had really collapsed a lot. It dropped over 25% during the time that gold was dropping $150 an ounce, and that was still when it was in the 1365 level. And so we've dropped another $100 an ounce from there, and we will be looking at gold in just a few minutes. But I just wanted to show you that silver appears to be going down to a double bottom from the 2010 low, which is down around $14.50 per ounce, and I'm not even sure that's going to hold it, but that's where it looks like it wants to go. It has certainly shattered the 786 retracement up around that 22 level. We talked about that several times, how important that 2150 to 22 level was, and then once the market starts to accelerate to the downside, then it does, make it interesting. Now, I don't think it's so much margin liquidation either, because they've raised the margin, by 25% on both gold and silver, and we will certainly be looking at that on a longer time frame. But most of these people, they only get about a 1 or 2 day call, and then they have to be out of it. So this is constant selling, and so it's people that are just leaving the market. And when they're leaving the market, it just tells that there's lack of interest in the market, and that makes it difficult for any rallies, because there's just not anyone there willing to step in and take a position on it. Now, we had we watched this gold bug index over a period of years, and we're going to take a look at it now, because I want to make the analogy to what we have happening in the gold bug index. What occurred back in September of 2011. If you'll take a moment, if you're still bullish stocks, and maybe you don't believe in pattern recognition, maybe you do, I don't know, but if you'll take a look at this gold bug index, you'll see this 1, 2, 3, 4, 5 expanding reverse point wave that formed there back in September, and that's when gold was trading at 1932 per ounce, and silver was up around $49 an ounce. And so once that pattern was complete, you can see that the market has been going down for well over 18 months, and that's what I think we have happening in our stock market right now. It's the same pattern, this 1, 2, 3, 4, 5 reverse point wave, and it's the most accurate of all the patterns that Gartley ever brought out in his book, and he had a whole bunch of them in there. It was known as the T6 pattern, and it is really a phenomenal pattern, because it has the beautiful parts of the geometry of the two triangles being equal, and then you have the ratios of 1.27 and 1.618 filling in at the same time. And that's why it's basically a monster trap with a 3-drive pattern, and that's what's happened in the stock market just recently. And that's when we had all of the people with the bullish consensus higher than it was at any time since 2000. So that's another reason what we're looking at for something rather sinister in the gold, that it's continuing to go down. But the pattern that we see in the gold bug index is just like the one we had in the Dow Jones. There's really no difference between the two, and it's important that we realize. See, I don't see any bottom in gold. I'm going to do gold next, and I know we got a break coming up here, but we'll expand on gold a little bit by doing both the daily and the weekly. But it looks to me, without very much problem, that gold is going to be going down to the $11.70 level. That's $11.70. $1,170 per ounce level is what it looks like it's going to do, because of the fact that it's going to be testing the 2008 low at that point, and we will be watching that level pretty good. I want to do something. We're going to take a break, but I've got to get this line drawn in here to show you the 61% retracement that's coming in at $1,170 an ounce in gold, because that's where I really think it's going. I mean, we're only trading at $12.32 now, so we're 1 day away. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direxion Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direxion Shares gives you the tools for both sides of the trade. Discover how we can help at DirexionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direxion Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direxion Shares. To obtain a prospectus or summary prospectus, please contact Direxion Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're back, and I posted into Tiger TV the long-term weekly chart on gold going back to 2008. And as you can see, we have been heading downward towards this 61% retracement that comes in on the gold at around $1,170 per ounce. That will be happening probably, we're only $60 away, and since we're dropping $40, $50 a day, we could be there, either today, tomorrow, or Friday, and then we will take a look at it. The problem that we're having here is that we're having a situation where there's people leaving the market. I mean, the open interest is dropping in gold, and that's not a good sign for the bulls. When people walk out of the market, the market will just fall of its own weight because there's no bullish enthusiasm to get the market to move higher. But that is a very long-term pattern. If you'll notice the chart, and it's important because we brought this up several times, is that ever since we made the high back at 1795, which was the big 61% retracement, that was $17.95 per ounce, I think, right near 1800. And ever since that time when it broke down, we would have very shallow weekly rallies, 3 or 4 weeks where the market might rally of $60, $70, maybe $90 an ounce, and then it would quickly give it all back. And that's what's happening now. We're seeing the capitulation of all this down moves with these shallow rallies that we have has made the market susceptible to these sharp drops that we're getting right now. Now, I'm not sure whether it's going to hold at $11.70 per ounce, but at that level I will certainly be interested in it because of the fact that it is at that most famous 618 number, and it's also completing several ABCD patterns. And with all that, what I'll probably look at is to maybe look to the options market, because with the stocks, with gold getting hit as badly as it's been hit, the price of these options is going to be relatively cheap. In other words, you could buy something $50 or $100 out of the money and not have to put up an arm and a leg, because at that level you'll have to risk somewhere around $1,500 to trade gold, because at that time it would be a $117,000 contract, and they've raised the margin now to 10%. And the only way they're going to get buyers to come into the market is if they drop the rates, drop margin rates down, so that it's more speculators to come in. So what they're doing now is they're actually squeezing the longs out of the market, and they're squeezing the shorts too. Well, not so much the shorts, because they're making a lot of money, but this is what happened to gold and silver during 1980 when the Hunt brothers were trying to manipulate the market. They raised the margins to 200%. Instead of going to 25% margin, they went to 200%. So that basically killed the silver and gold market, and that led to the 32-year bear market that finally ended in 2003. At below $300 an ounce. Whether that's going to happen this time or not, I'm not sure. But you don't bring new buyers in the market by raising the cost of getting into the market, and that's what's happening. Now, the next one that we need to talk about here, hopefully we'll start covering it now, and when we get to the break, we'll cover it more, and that is the euro versus the U.S. dollar. We were watching that last week when it was up at that 134 level, because it was completing the big ABCD at that level, and we've been down for 6 straight days, well over $3,000 a contract in just a very short period of time, and we're actually now trading below the 61% retracement of that move from May the 20th all the way up into June the 20th. We've retraced over 61% of that in a matter of 6 days from last Thursday, when the Fed was in the market acting. It looks like it's going to go lower, but we could get a bounce here of several hundred points, which would not be surprising, because if you look at the euro on a weekly chart, and we will take a look at that now, you'll see that the euro on the weekly chart has such tremendous bearish qualities, with these lower tops from 2008 all the way through where we are now. And we just finished the last little Gartley. Well, I don't know if it's the last one, but we just finished a smaller Gartley on the weekly chart at that 134 level. We were watching it on the daily, but as you can see on the weekly, it was the same price, and that gives us a price level of 124 in the euro. That's down another $6,000 if, in fact, the euro is going to break that. So it takes a lot of patience to stay with it for all that period of time, and you can't watch it. But we're going to take a break now. 877-927-6648.
With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position, for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV. But if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're back, and we're talking about money and the Forex markets, and we talked about the euro going from 134 down to 130, and it looks like it's going to go a little lower. At any time, we could get a 200 or 300 point rally in the euro because it dropped 400 points very, very quickly, so it's incredibly oversold, and we could get a bounce without much reason at all. Now, the next chart that I posted in the Forex group is the pound versus the dollar. This used to be the king of commodities. Let's try that again. This used to be the king of the Forex market up until 2000 when the euro was introduced in 1999. It took about a year for it to get to be popular, and then it took over. The euro versus the dollar became the king of the currencies as opposed to the pound versus the dollar. When I first started trading the British pound, it was trading at 5.40 to the dollar, and now it's at 1.50 to the dollar. That could just show you what happens to a person's or to a country's currency when the government sort of lets things go to the dogs. And I'm a little worried that some of that stuff might be happening to our dollar here, but at least it's holding up. Now, we're going to take a look at the British pound. That's the one that's into Tiger TV right now. It shows that we had the big 61% retracement that occurred last Thursday after the Fed acted. And here again, we've also come down to a near perfect 61% retracement near 5,300 in the British pound. And that should be a level where we get our next bounce off of. But it's down 6 days in a row, so it's certainly oversold. And it has a potential for having a rally if we can hold this 153 level, in the British pound, which at this particular stage, it certainly looks like it could do that without very much trouble at all. Now we need to look at what's happening in Japan, because we've had some really big moves occurring in the currency markets. Especially in the Japanese yen versus the U.S. dollar, that moves around $1,000 just faster than just about anything, with the exception of crude oil and also the price of gold. The gold is, of course, moving, $4,000 a day, and crude oil moves around $1,500 to $2,000 a day. And when you look at that in relation to the margin that's being charged, that's a tremendous amount of volatility, i.e., opportunities. So, when you learn to, handle these markets as far as the risk, you want to go to the things that are the most volatile, because that's where you have your greatest potential. If you remember the death of a salesman, they asked Willie Lomax, why do you rob banks? And he said, that's where the money is. Well, the money in the markets that we look at are in the Forex market, because they move very, very actively. They're traded 24/7, 5 days a week, and they give you plenty of opportunities to be right, and it also gives you plenty of opportunities to be wrong. So your job is to try to find, the best patterns that you can see happening, and that's what we try to do here at TFNN with the different newsletters and broadcasters that we have here. And they're all very top quality, and I've been in this business a long time, and I listen to them, and I respect all the work that they do, and it is quite interesting to see how well they agree on so many things. It's very seldom that they come in and they all, disagree on something. That's because they're technicians. If we had a fundamentalist thrown in the mix, it would certainly be different, because people view the fundamentals as something, easier to understand. But frankly, the fundamentals don't always follow the market. A perfect example of that is Apple. Look how bullish the fundamentals were when it was at $703 a share. 33 analysts on Wall Street were bullish out of 33 for 33. That's never happened before. And now it's 0 for 33. Well, I think a few of those guys are still bullish, but they're underwater so much that it'll take a great deal. Maybe a Steve Jobs reincarnation would do it, but other than that, I don't see too much reviving Apple. There's something wrong somewhere in that company. They're not telling us what it is, but the stock doesn't drop in half without good reason. And that's my 2 cents worth. I'll get off the soapbox, and we're going to take a look at the Japanese yen here versus the dollar, because we've had a pretty good correction from the high we made at 103, and it looks like we are getting ready to we've had a pretty good rally back over the last 5 or 6 days. And again, we've held up against some strong resistance. The last one was at the 786, and it appears that the yen is making some type of a major top up in this area, which would mean that the the Nikkei Dow would also be making a major top around this level. We're talking about the Japanese yen here. The last rally back that we've had since the middle of last week has just been a 50% retracement of the last high, coming off of that 93 level, which was a 382 off of the whole move, which we talked about several times. So it still has a chance, to be bullish. But if we go below 93 in the Japanese yen, it's going to be, a problem. Someone has asked me a question about my bearishness, and I've already said that I am very bearish, longer term with stocks and bonds. And what would cause this? Folks, I have no idea. It could be an outlier event, something that we're totally, not suspecting, like a war or something like that, a natural disaster, something in the neighborhood of what happened with Katrina, or even worse. There's just so many things that could trigger this down. And it also could be that the banks start telling the truth about what they're really doing with the money. And then we'll really see what's happening, because they certainly haven't been putting it into the economy. Otherwise, we would be having people with a lot more jobs, and the jobs are fading away. They're not coming back, like they were back in 2007. And so we have to fight through that, and that's what makes it more difficult. The question has come in. If you'll give me 1 second, I have to change something here, and so that we can take a look at the NASDAQ, because we're having a very nice Gartley pattern forming in the NASDAQ today. It's right up at the 61% retracement. And remember that the NASDAQ had been the one that was the leader of the pack up in here, and I think that we've got a chance to make a little bit higher in the NASDAQ, up around the another 15 or 20 points, and then we would have a pretty good idea that the NASDAQ should be completing a Gartley pattern at that point, and that would give us a spot to re-enter the short position. But this has been in a massive top building, as near as we can tell, over the period. As a matter of fact, I posted the wrong chart. I hit the 2-minute chart on the NASDAQ, and that was not. Oh boy! Don't ever give an Italian a mouse, folks, because he will mess it up. And that's exactly what I did. I hit the wrong toggle button. Instead of hitting the daily, the 2-minute chart came up, and we certainly don't want to be trading 2-minute charts. But we will take a look at this Gartley that we had that formed on Monday morning. That's when the NASDAQ completed its 786 retracement ABCD Gartley pattern. And we've had a very strong rally. I would expect it to go just a little bit higher, probably, like I said, about another 20 points in the NASDAQ, and then we would be looking at, another move to the downside. But longer term, it has some very bearish ramifications. The fact that we were able to break out below the May lows, we've come back to those May lows again, tells us that everybody that bought stocks from the month of May is pretty much underwater. And if they bought something like Apple, then they're looking at something that they're really underwater in, and that makes it even more sinister, by watching that particular move happen. There was one other one that I wanted to mention. Let's see, we talked about Forex, we talked about gold. I wanted to mention, I know tomorrow is the commodity show, but we have the corn market has come down, to the level that we think it's at a pretty good buying opportunity. We're still down at this $5.43 per bushel level. That's a 61% retracement of the whole move. The market rallied well over $2,200 per contract after we had the big ABCD butterfly pattern down at the bottom on the 17th of June. And remember, that was exactly almost to the day, one year from the low that we made on June the 10th of 2012, before we started the big, drought market to the upside. And we're going to see if weather's going to be playing a role in this, because the 618 should hold, and if it doesn't, then you're looking at another 20 cents to the downside to the 786, and you can't take that heat. So if you buy corn in this area, the most you have to risk is about 7 cents, which is $350, because each contract is 5,000 bushels, and it's priced at a penny per bushel. Each penny is $50. So if there's 5,000 bushels, you multiply it by a penny, you come up with the value of the contract that we're looking at, and that makes it pretty a pretty valuable commodity. This is the most lucrative crop of any crop that we have in the United States, and that's why it's one of the more heavily weighted. And the margin on trading corn is still relatively cheap. It's still under $3,000, so that makes it very nice tradable instrument for booking profits, and also for taking a position. You can become a farmer without having to have a farm, and that's the ideal situation, because you don't want to have too much happening with the labor and all the people that you have to hire when you're doing this. That makes it pretty tough. Okay, we've got a call from Rick in Orlando, and Rick, are you there?
Yes, I am. Thank you.
What can I do for you, my friend?
Well, I'm watching this nice little pop in the market, and I'm expecting it to... Hold on, let me get rid of the radio. I'm expecting it to go up a little ways, to some point, 0.638 or whatever kind of retracement in the market.
Yeah.
And that's why I'm looking for SDS to continue its little ABC up.
Yes, we've completed one ABCD yesterday, and that was near the 50% level. I'll post these into Tiger TV so that when you get a chance, you can go and look at it. But what I'm watching now is a potential pullback in the SDS, which we'll be watching down to around the 40 level, and from that level, then we would start another leg up, because we've been rallying since the 27th of May, and so we're just about at the end of that.
Okay, yeah. What I was concerned about is if it wants to go and fill that gap up there or down there.
Oh yes, that's certainly possible. That would be down into that gap area about 40, and that would be the thing that you'd be looking for it to do. But I don't really trade ETFs. I don't trust them anymore. And yeah, they just don't make sense to me, and for a lot of different reasons. There's just too many things that are easy for us to trade now, as opposed to picking out something that someone made up out of thin air. Not that the commodity contracts are not made out of thin air, but at least they're validated by some serious history.
Yes, understand. Yes, sir. Well, maybe I'll consider something else. It's just that when I was looking through and scanning, I'm afraid to long any of the stocks, but I could short some weak ones, I guess. Find some of the ones that went toast not too long ago.
Well, that's the adage, Rick, is you sell the weakest and buy the strongest.
There we go.
That's probably the best thing to do.
Okay, so I'll look for 40, and I'll be watching that gap if I decide to stick with that SDS.
Yeah, that's for sure. And if it goes below 38, I'm certainly wrong.
Well, we'll see where she goes. I sure appreciate your help, sir.
Well, thank you very much for calling in. We appreciate it, Rick.
Yeah, you have a good one.
Okay, thank you. Okay, we're going to take a look. My reasoning behind the ETFs, as you've probably heard me on the show before, is that they don't always follow what the stock markets do. I mean, the GDL, which is the gold one, it follows pretty good. The silver one follows pretty good. But some of these others that are double and triple leveraged, boy, I have a really strong feeling about those. For instance, with TLT and TBT, we've had the same thing happening, that they don't always follow to the T of what you think the things are going to do. Since we're talking about the TBT, we might as well switch over to the bonds right now. And what I'm going to do is we're going to look at a little shorter term picture in the bonds right now, because we've had a really strong rally over the last few days, starting last week, and that was coming off the 132 level, and we've rallied $3,000, and then we've had some nice patterns form on bonds intraday here over the last several days. In fact, we're in the midst of we had a bearish Gartley form earlier this morning up at the 135 level, 135.10 level, and it makes it look real interesting here that the next move down should stop around this 134 retracement of the previous highs, because the longer term picture on the bonds is just so incredibly bearish that you just cannot. We got to take a break here, folks. Then we'll talk about bonds.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we are going to talk about Treasury bonds because something significant happened on Monday. We did break below the lows of 2012, which occurred last in March. 16 months ago, so that means that rates are now higher than they were over a year ago. That's the first time we've taken out a yearly low in a very, very long time. And remember, this has been a 33-year bull market, so by any stretch of the imagination, we could be looking at higher interest rates, and that's certainly what the charts are telling us on the Treasury bonds, that we are looking for much higher rates. That doesn't mean we can't rally from here, because we've hit some major support through this level, but we've had these head and shoulder patterns form, and as a matter of fact, the head and shoulder patterns that we've been watching in the notes in the bonds, we actually made the first objective of that, which would have been the 61% retracement of the last high, has actually occurred in the Treasury notes. So when you look at the long-term weekly chart, which we're going to post here into Tiger TV so you folks can take a quick look at it, and then we'll see how it looks. I'll put that in here now, and you'll see this head and shoulders pattern. The price objective on that of the right shoulder was down at the 618, and we went down to that level on Monday, and we're way below where we were in 2012. The bonds have just gone below the level by a little bit, but we're substantially below it in the Treasury notes. And Treasury notes are the ones that you use for the credit cards and your mortgages and car loans and stuff like that. So they're very important. These are the shorter term things, 10 years and under. Usually 1 year to 10 years will be the notes, and then the bonds are past 10 years. 10, 20, and 30-year will be the bonds. So those are the ones that seem to have the most interest of what's happening. And we're incredibly oversold in the notes. I think we're down. This is the 10th week in a row where rates have gone higher, i.e. Notes going lower. And so we're due for a pretty good correction to see if the oversold condition will be corrected. And if we do get a rally back, say 5 points, maybe 6 in the Treasury notes, that will be a good place to look at them from the short side, because you'd be selling against a head and shoulders pattern. The trend is certainly down, and that's the ideal situation for trying to get short, is to look at those parameters. The fact that the trend is down on a longer term basis. We've taken out last year's low that definitely qualifies as a downtrend, and so we would be looking to sell the first ABCD rally that we get. We haven't had one yet, but we'll take a look at the hourly chart on the notes, and you'll see that would come in a little bit higher from where we are right now. And this is the end of our show, folks. Hard to believe we're having so much fun. Live every day in an attitude of gratitude, and may God bless.
Hi, folks. I'm Steve Rhodes with TFNN.com, and the trend is your friend until it changes. A free special report is now available on the homepage of TFNN.com, and if you have money in the markets, this free report is a must. If your strategy is buy and hold, this report is a must. If you're a day trader, a swing trader, a Forex or options trader, or just getting into the markets, this report is a must. And it's the second best gift you'll ever receive. Look, if you buy a stock and the general market is trending in the other direction, you've reduced your odds of buying at the right time by 70%. Instead, let me teach you how to get that 70% Advantage Plus. The Plus is a free trial to my daily newsletter service, Mastering Probability. There's no upfront deposit, no charge to your credit card, and I compress decades of education into each daily newsletter. This is a limited time offer, so act now, and I'll teach you how to take the trend and turn it into your best friend. All the details are on the homepage of TFNN.com. Act now.